So welcome all for today's AFR session. So I want us to open that question, May 2019 question 3B. We'll be doing company reconstruction. And just to remind you, we see that we have two types of company reconstruction. We have internal reconstruction, as well as we have external reconstruction. And you see that the difference between the two is that at the internal reconstruction, there is no liquidation. The shareholders and the debt holders, they just compromise so that they sacrifice their wealth or their claim so as to save the company. But internal reconstruction, this is where a new company is being usually formed to take over the asset of the existing company. Then we say that internal reconstruction is the same as capital reduction. It's also known as the capital reduction scheme. And we see that under capital reduction scheme, how do we prepare the capital reduction account? Capital reduction account. You see that in the capital reduction account, on the credit side, you bring what the shareholders and the debt holders sacrificed. So you bring the ordinary share capital. That's what the shareholders sacrificed. Also, share premium. Also, revaluation gains. And then anything else that the debt holders, for example, the preference shareholders, the creditors, anything that they sacrifice. So you also bring the debt holders sacrifice. So in that case, then on the debit side, you debit accumulated losses. Also, goodwill written off. Also, revaluation losses. So that's how you prepare the capital reduction account. So now let's do this question. May 2019, question 3B. So we are told that Matatizo Limited has been recording losses for the last few years. The statement of financial position for the company as at that 1st March 2019 was as given below. So you have that. The authorized share capital of Matatizo Limited is composed of 5 million equity shares of shillings 10 each and 200,000 10% preference shares of shillings 100 each. It was decided during a meeting of the shareholders and directors of the company to carry out a scheme of internal reconstruction with effect from 1st April 2019 as follows. Number 1, each equity shares are to be designed as a share of 4.5. So how much was the par value per share? It was 10. It was designed or it was written off to 4.5. So that means every share has ordinary share capital, it had a par value of shillings 10, then it should be designed or to be written off to 4.5. So that means there is a loss of share of how much? 5.5. So how do you account for that? We say that under capital reduction account on the credit side, you show that the shareholders or the ordinary shareholders, they sacrificed their wealth. How many ordinary shares they had? Let's go to the equity. How many ordinary shares did they had? They had 3,000 shares, and then the share were written down to 4.5. That means every share lost by how much? 5.5. So how much they reduced? To get 16,500. Good. That's the wealth that the shareholders sacrificed. Then you are told that the equity shareholders are to accept a reduction in the nominal value of the shares from 10 to 4.5. In addition, the shareholders are to subscribe for a new issue of shares on the basis of 1 share for every 3 held at a price of shilling 6 per share. Then the ordinary shares agreed to effect a rights issue. And what was the term? We are told that in addition, the shareholders have to subscribe a new issue of shares on the basis of 1 share for every 3. Are you together? 1 share for every 3. So it's 1/3. How many shares did they have? They had 3,000 shares, and each was issued at 6 shillings. So how much cash did the company receive from the rights issue? You get? Yeah, 6,000. So now this one goes to the cash account, and then you credit the ordinary share capital. Number 2, the existing preference shareholders are to be exchanged for a new 15% preference shares of shillings 100 each, and 500 equity shares of 4.5. The preference shareholders. How much was the preference shareholders? Preference share capital was how much? Was it 10,000? Now they sacrificed their wealth. Now let's be here. Preference share capital. It was how much? They had 10,000. This 10,000 is to be exchanged. Let's do that again. The existing preference shares are to be exchanged for a new 15% preference shares of 100 each. So they were given 55,000 shares each at 100 plus and 500 equity shares of shillings 4.5 each, and 500 shares each at 4.5. So do they sacrifice anything? Yes. If you take 55 times 100, they were given preference share worth that, and then in addition they were given shares worth 500 times 4.5. So in short, they were exchanged with a debt of 77.50. But the preference share capital was how much? 10,000. So that means they sacrificed some of their wealth. So it's 10,000. You minus that, and they sacrificed a wealth of 22.50. Good. A preference shareholder, they are part of the debt holders. Then number three, the 12% debentures are to be converted into 15% debentures. So that means in this case, the debenture holder, they are not losing anything because it was just converted. So in this case, what they did, they need to extend the period, but they increase the interest rate from 12 to 15. Then you're told that a further 1 million of 15% debenture of shillings 100 are to be issued at 70, at 75. Yeah, that is a further to be issued. That one will not affect our capital reduction account. Number 4, the directors agreed to forego 50% of their loan. Can you go to the equity and liability? Can you see directors loan? Loan from directors was how much? 5,000. Directors, this is a loan. Are you together? So you're saying that under capital reduction scheme, this is where the ordinary shareholders and the debt holders sacrifice their wealth. And you are told that, let's read again, number 4. The directors agreed to forego 50% of their loan. So directors loan, they sacrifice their wealth. Directors loan 50%. How much was the value of the loan? 5,000. They sacrificed the wealth of how much? 25. So the director agreed to forego 50% of their loan. The balance of the loan was to be settled by the issue of 400 equity shares or forfeit. They also sacrificed something else. Now let's be here. The loan was 5,000. Are you together? They sacrificed half of it, which is 25. So that means how much is the balance? The balance is 25. And this 25, it was exchanged through the issue of shares. So now let's go through that. The balance of the loan is to be settled by the issue of 400 equity shares or 4.5. They were given ordinary share capital, 400 each at 4.5. 400 times 4.5 is how much? You get? 1,800. Are you together? So the balance, they were supposed to be paid 25, but they were given shares worth how much? 18. So there is a difference of how much? 7? Is it 700? Yes. So also directors loan, they did not only forego 250, they also had a balance of 700. Also directors loan, again, you take 25, that was the balance that was supposed to be paid, of which they were paid 400, 4.5. So the balance is what they sacrificed. of which you get still it's 700. Good. Number 5. The bank overdraft is to be repaid in full. So that one will affect the cash account. Number 6, all intangible assets and accumulated losses are to be eliminated. We say that how do we eliminate asset written off? In short, it's what we call evaluation loss, or the asset, their value was scrapped. So in this case, you debit. So you bring the accumulated losses. How much was accumulated losses? Yeah, accumulated losses was an amount of, yeah, it was 2,000. Also, you're told that all intangible assets and accumulated losses are to be eliminated. Let's go to the assets. All intangible assets. One, we have what? We had goodwill, an amount of 5,000. Can you see patent and trademark? Yeah, patents and trademark, an amount of 500. Okay, then, number 7, creditors accepted to be paid half of the amount due at a discount of 10. Creditor is part of the debt holder. They have sacrificed the other how much? Can you compute that? Okay. Creditors. How much was the value of the creditors? It was 2,200. Did they sacrifice anything? Yes, they gave us a discount. Are you together? So creditors accepted to be paid half of the amount. So you multiply by 50. So 50% of 2,200 is how much? 1,100. Of that 1,100, due to a discount of amount due at a discount of 10%, then they give us a discount of 10% of the amount we are paying them. So 50% of 22, that means we pay them 1,100. But of that 1,100, you raise the discount of 10%. How much do you get? Is it 990 or 110? 110, eh? Yeah, because it's 1,100 times 10%. Are you together? Yes. Then, number 8, assets are to be adjusted to their fair values by the following amounts. So, in this case, we had a revaluation. Printed machinery, did it get gain or loss? Was it a gain or loss? Printed machinery. A loss of how much? A loss of how much? 20? 23,900. Now, can we read that statement again? Assets are to be adjusted to their fair values by the following amount. It was not revalued to. We are given it was adjusted by the following amount. So that means printed machinery lost by 61, equipment that 250, receivables 1,160, and also inventory an amount of 460. It was not revalued to, it was revalued by. And in that case, in this case, they're not saying that it's a fair value gain or loss. But in this case, whenever you're facing reconstruction or facing financial difficulties, you don't expect the asset to be revalued upward, rather they be revalued downwards. Good. Number 9, the share premium account is to be utilized for the purpose of capital reduction. Share premium, debit, credit. You credit, yeah, the share premium. In this case, the shareholder who are sacrificing their wealth. Share premium. And we say that for the share premium, you only factor in what they had at the time of reconstruction. The new, the right issue will not affect the share premium in the capital reduction. So how much was the share premium? It was 4,000. For example, in this case, the shares, how much is the par value of the shares? The shares were written down to be redesigned from 10 to 4.5. And then, remember we had a right issue, of which we issued an amount of, how many shares did we issue? Hey, can you go back to note number 1? Each share are to be designed to shillings 4.5. The equity shareholders are to accept reduction in the nominal value of the share from 10 to 4.5. In addition, the shareholders are to subscribe for a new issue of shares on the basis of 1 share for every 3. And this is what we did here, the right issue. For every 3, you get 1. What about 3,000? You get how many shares? Which was other? 1,000 shares. Each at how much? 6. So that means we got a cash of 6,000. So what do you debit? What do you credit? What do you credit? You debit cash account with an amount of 6,000. Then you credit number 1, ordinary share capital. Remember, I said that the ordinary share capital is always recognized at par value. So we issued 1,000 shares, and the par value is now 4.5. That means we issued at a premium. 1,000. The par value was the share was designed to 4.5, but we issued each share during the right issue at how much? 6 shillings. Are you together? So 4.5 to 6, that means there was a premium of how much? 1.5. Are you together? So you credit ordinary share capital by 45, and then you credit the share premium by how much? 50. Now this 15 will not affect your share premium in the capital reduction. Required capital reduction account for Matatizo Limited after completion of the internal reconstruction. Actually, they only wanted this, so they don't have to present that. So was it a successful reconstruction or not? So let's get the balancing figure. In case it balances, we say that that's what we call as successful reconstruction. In case it doesn't balance, the balance becomes the capital reserve. Here I'm getting 26,060. So here I get 7590, the balancing figure. That's what you call capital reserve. It's a capital reserve. That means they reduce more than what they had lost. So you can copy that. You can just take a screenshot.